Quality-based investing is really about targeting above average companies at reasonable prices and ignoring weaker companies regardless of potential entry price. Now, the reason that this is a viable investment strategy is that at all times, the companies that you're targeting are resilient to unexpected changes in economic circumstances, yet they retain the ability to compound and grow to provide that capital return that investors crave over the long term. So ultimately, we're looking for companies that have a reason to exist out into the future and have an ability to grow out over that time horizon. And these companies, we believe, selectively targeting these companies provide differentiated returns for investors over the long term. Well, the number one rule for quality-based investing is capital protection in down markets. And why this is important is when we enter periods of distress, we see the risk of company failure. Now, if you lose money on a company because it's gone out of business, not only does that cost you money at the time, but that's money that will not compound through the recovery phase as well. So if you can avoid those companies, it's probably the number one driver of long-term investment returns. If we think back to the GFC at Northcape, our Australian equities portfolios had no exposure to companies that failed through that period. Whereas a passive market exposure, unfortunately, will have retained exposure to companies that did go out of business. So that is a compound problem for investors over the long term. An advantage that quality-based investing has over style-biased approaches like growth and value is that it doesn't rely on specific market conditions to deliver outperformance. We can find quality-based companies at both ends of that spectrum, which means that it's less important for investors to time their entry into markets because these companies, because of their underlying attributes, are more likely to grow consistently over time and produce a much less volatile track record of relative performance. The third point I'd like to note about our investment style, quality-based investing and its attributes is around ESG. So for some investors, ESG is purely an issue of ethics or morality, but we actually think there's a strong financial underpinning to ESG being integral to this approach. And that's because thinking about the long-term survival and viability of companies necessitates a consideration of things that might impair that track record into the future. So these are things like carbon emissions, as well as social license to operate. So this isn't simply an add-on to our investment process, it's fundamental to the way we consider quality-based investing. So we're seeking a range of different attributes that all give rise to the quality that we're looking for. So the first one is we're looking for companies that have dominant market shares because these are the businesses that are most likely to survive for decades to come. A business like ASX is the financial infrastructure of the country, and it's likely to be continually relevant for investors and for our markets for many years to come. A second attribute that we're looking for is high operating margins. So if we think of a business like Transurban, its revenues run at a rate of more than 4 times its costs. So if we do go through periods of uncertainty and inflation, then the profitability of that business is quite insulated from those conditions, and distributions are still possible to be paid through to investors throughout those unstable conditions. A third important trait is high return on capital. And so we see a business like BHP, which generates very large returns on its capital invested. Now that allows it to invest to reduce its carbon footprint over time and thus remaining relevant for the global economy for years to come, as well as then invest in the new avenues of multi-decade revenue and profit growth for investors, such as their potash development in Canada. Now, potash produces potassium, which is a vital ingredient for crop growth in our agriculture right around the world. In summary, we're seeing volatile investment conditions at the moment, prompting a lot of uncertainty for investors in how to position. And we think the ideal solution here is to focus on companies that are going to protect that capital if conditions do deteriorate, but retain that ability to compound growth into the future. This is something at Northcape we've been doing for many years, and we're very excited about the investment opportunities that we see in today's market under this framework.